India's economy is rising, but behind this growth lies a storm in the shadows of our financial system. A silent crisis is growing, one that threatens industry, jobs, and your money. This is the story of India's struggling corporate bond market and how fixing it can unlock true sustainable growth. Despite years of reforms, India's BFSI, banking, financial services, and insurance sector, faces deep-rooted problems. One major pain point? The corporate bond market. Problem 1. Shallow, illiquid market. India's corporate bond market is small and dry. Few investors, few trades, no deep market. That means companies cannot borrow easily and industries suffer. Problem 2. Opaque trading. Investors don't trust what they can't see. Bond trading is hidden, unclear. There's no transparency, and that keeps confidence low. Problem 3. Neglected secondary market. The RBI wanted a vibrant secondary bond market, but exchanges like NSE ignored the push. Why? Because equity gives better profits. Bonds were sidelined. Problem 4. High cost of capital. Due to all this, borrowing through bonds costs 2-3% more. Industries pay more. Jobs suffer. India loses. Problem in BFSI, nomination chaos. But wait, this isn't the only trouble. Across banks, mutual funds, insurance, there's chaos in nominations. Who inherits the money? The nominee or legal heir? No clarity, no harmony, only confusion and court battles. UBO. Ownership transparency. India is part of FATF, a global group fighting dirty money. SEBI struggles to trace who's behind the money. Problem 6. Loopholes in disclosure rules. India asks for UBO details if someone owns 10% for companies or 15% for partnerships. But FATF wants 25%. Clever investors stay just below these limits and hide. Retirement planning. Even retirement planning is broken. Most Indians, including BFSI professionals, are stuck with annuities. And annuities carry a hidden cost. 2% fees from insurance companies. Better alternative? Yes. Zero-coupon government bonds. They're simple, safe, and don't charge high fees. Over 30 years avoiding that 2% fee can mean big gains. But the government hasn't promoted them properly yet. And there's one more shadow looming large: shadow banking. NBFCs, margin lenders, brokers, they act like banks, but without full regulation. Dangerous practices. Brokers lend at 20% plus interest using tricks. They take your money as collateral, then lend it back to you, and charge full interest. Investors often don't even know. It's a risky blind spot. The time for patchwork is over. India needs real, deep reforms. So what can it be? Harmonized nomination rules. Structural corporate bond reforms. Lower UBO disclosure limits. Promote zero-coupon bonds for retirement. Regulate shadow banks like EU does. Build transparent, data-driven oversight. Fixing the corporate bond market can reduce costs, boost industries, and create jobs. Transparent finance builds trust, and trust builds a strong economy. This is not just a financial story. This is India's story, and the reforms we make today will shape our tomorrow. Like, share, subscribe.